Let's go back to these yields here for a second. I want to kind of continue this conversation because right now we're looking at the 10-year and we're down 5.1 basis points. So we're at 4.646%. And really the bond market seems to be in charge right now, if you will, for several reasons. I want to bring in EY-Parthenon chief economist Greg Daco. And there's a few things going on in the bond market. It really seems to be driving the news right now. So Treasury Secretary Besson said that he was asked about bond buying, and he said, I haven't bought a single bond. That was one. Then there's this piece in the Wall Street Journal editorial board that says, let the bond market speak. And here's what they write. Rising interest rates are a signal of trouble ahead. Artificially suppressing it heightens that danger. That, to me, sounds like a swipe at Treasury and some of these moves that are either being talked about or have already happened.
Yeah. I think what we're seeing in the bond market is a reflection of structural signals that are pressuring up long-term yields. Yes, there are certainly cyclical factors that are pushing up long-term bond yields, including what's happening in the Middle East. But if you look at the underlying forces that are pressuring up long-term rates, it's a combination of factors that are structural. It's the debt rising to $40 trillion. It's interest payments on the debt, over $1.1 trillion per year. It's inflation volatility that's likely to stay with us for quite some time. It's the pull for private capital from the AI investment boom, and it's questions around Fed credibility. All of those factors are structural factors that are likely to keep this upward pressure on long-term bond yields. And so when you ask what the Treasury is doing to try to suppress some of these higher interest rates, there's a question as to how sustainable any type of policy intervention can be. And you're going to have to do more and more because it signals that you are concerned about long-term interest rates and you're not addressing the underlying causes of this structural pressure on long-term rates.
You just mentioned it, though. You mentioned that $40 trillion in debt. And is that a warning sign for the U.S. economy?
I think it's a warning sign for the U.S. economy, but it's not just the U.S. economy. Economies around the world are all seeing rising deficits that are structurally higher because there are more pressures to finance defense, to finance industrial policy, to finance aging demographics, and that is leading to more spending, and at the same time, revenues are not following suit. So you have these rising debt burdens that are lifting long-term rates, not just in the U.S. The U.S. is the center of attention right now because the Treasury market is the most important in the world, but you have to remember that this is a global phenomenon, not just a U.S. one.
Well, certainly, and this goes into the spending, goes into the inflation story, and I want to get into that with you. We do have PCE coming out tomorrow morning, and this is going to give us, insights into the strength of the consumer or the pressure, better yet, on the consumer. The Conference Board, consumer confidence, it fell in August. Sentiment became a little bit more pessimistic. And if you look at inflation historically, we've been running at 3 to 4%, well above the Fed's target since 2021. So, what does that tell you about that time frame? I mean, that puts long-term pressure on an economy. We do have a stable job market, I will say that. But the inflation story is still
We're fortunate to have a very stable labor market because that has been allowing for income to grow at a positive rate. What is really concerning right now is that the recent reacceleration in inflation is eroding consumer purchasing power because income growth is being eroded by this higher inflation environment. Now, we are expecting over the next couple of months to see some disinflation momentum. We are expecting to see tomorrow core PCE, which is the Fed's main gauge for inflation, rise about 0.2 on the month, and core inflation ease back to about 3.2%. Still quite some ways from the 2% target, but that easing of inflation, we think, will put the Fed on hold for the September meeting. So we don't expect a rate hike.
You don't expect a hike.
Yes.
And I know that we're talking December now for the bets, but that changes so much. But I had Keith Banks on this morning. He's a former vice chair at Bank of America, and he said, look, second half of 2026, we're going to see 4 or 5% growth. We've heard Kevin Hassett tell Fox Business he believes 4 or 5% growth in that range at least. So you've got these bullish calls being made on growth. Do you agree with that?
I don't think we're going to see 4 or 5% real growth. Inflation-adjusted growth is likely to be around 2% for the remainder of 2026 and into 2027. The reason being that this higher inflation environment is eroding consumer purchasing power. And we know consumers are the main engine of growth in the U.S. So if you have that erosion of income momentum, it's constraining people's ability to spend. And so you're not going to get as much or as strong of an engine of growth going into 2027. There is some demand destruction occurring because of higher inflation.
Well, and that's the concern. Real real quick, what do you expect to hear from Kevin Warsh Friday at Jackson Hole Symposium? This is his first time, obviously, speaking as Fed Chair.
First speech, I think he'll keep it very tight. He's been very cryptic as to his own reaction function. I don't expect him to be completely transparent all of a sudden. I think he will keep his cards close to his chest, but he has an opportunity to regain some of the credibility in terms of how he's interpreting economic data and his optimal view for monetary policy.
But it's interesting, too, because it's, the reason I say I think this will be interesting at Jackson Hole is because it's a more relaxed atmosphere, more congenial, and there's going to be a lot more conversations.
A lot more conversations.
A lot of reporters are going to be there. I mean, there's going to be more information coming out of it.
But don't forget that the environment is quite sensitive. We've seen Treasury intervene or announce potential intervention in terms of controlling long-term interest rates, and at the same time you've had the Fed chair talk about wanting a clear signal from markets. There's that tension between Treasury and the Fed right now, and that's going to be a key topic of conversation.
All right, we're going to be watching for that. Greg, thank you for that heads up. Appreciate it. All right.